The Origin of Financial Crises, Central Banks, Credit Bubbles, and the Efficient Market Fallacy. By George Cooper. This is a book summary. What if I told you that the foundation of modern economics is built on a fantasy? That what you learned in textbooks, in lecture halls, and in glossy business articles was not just wrong but dangerously misleading? What if I told you that the financial system you depend on isn't just unstable? It's hardwired to break. Booms, busts, bubbles, and crashes, they are not flukes. They are not black swan events. According to George Cooper's explosive book, The Origin of Financial Crises, they are symptoms of a deeper disease. A flaw at the very heart of how we think about money, markets, and control. So buckle up. Because this isn't just an economic theory, it's the hidden script of the 21st century. This is the origin of financial crises decoded. We've been fed a comforting lie that markets are efficient, that every stock price, every interest rate, every trade reflects perfect wisdom, that invisible hands guide trillions of dollars with serene precision. They call it the efficient market hypothesis, EMH for short. It paints a soothing picture, a world where markets naturally seek balance, where bubbles can't exist because prices always reflect true value. A world where, if left alone, the economy hums like a perfect machine. But what if the machine has no balance? What if, as George Cooper argues, it has no equilibrium at all? The crash of 2008 didn't come from nowhere. Nor did the dot-com bubble, or the housing bubble, or the crypto bust. These weren't random errors. They were the system working exactly as designed. A system built on flawed assumptions and blind faith. Faith in models that ignored human behavior. Faith in markets that punish doubt and reward risk until they implode. This is the lie we live, and it's time we confront it. George Cooper doesn't whisper his critique. He tears the mask off our financial system. He calls out the comforting fairy tales written in our economics textbooks and replaces them with a darker, more honest truth. Our financial system, Cooper argues, isn't a calm, self-correcting river. It's a storm-prone ocean, surging, crashing, and always on the edge of capsizing. And what churns these waves? What feeds the storm? Credit. When banks start lending freely, the music plays. Homes get bigger. Stocks surge. Champagne flows. It feels like prosperity. But it's not growth, it's leverage. Every boom you've ever seen, from dot-coms to housing to crypto, has one thing in common: easy money. And when the music stops, when the banks tighten credit, that balloon doesn't deflate gently. The bubble bursts, jobs vanish, markets panic, governments scramble, and we act surprised again. But Cooper wants us to wake up. These aren't once-in-a-lifetime events. This cycle isn't rare, it's the design. And the central banks, the institutions that claim to be our guardians, sometimes they're the arsonists holding the hose. We like to think of central banks as the calm hand on the wheel. The adults in the room, when things get shaky, they lower interest rates. They buy bonds, they inject liquidity. Sounds responsible, right? But here's the twist George Cooper delivers with chilling clarity. Every time central banks step in to soften the blow of a downturn, they create the foundation for the next crisis. They don't solve the problem, they just delay the explosion. Cooper compares it to forest management. When you extinguish every small fire, deadwood piles up, underbrush thickens, and eventually, when the big fire comes, it's catastrophic. Each bailout, each rate cut, each round of quantitative easing, it feels like relief, but it erodes the system's resilience. Debt balloons, risk builds, and the illusion of control grows more fragile. We've created a world where no one is allowed to fail, where markets aren't allowed to fall, where pain is postponed again and again until it can't be. The result? An endless chain of ever larger booms, followed by ever bigger busts. The system isn't stabilizing, it's spiraling. But what if we've been listening to the wrong voices all along? In a world hypnotized by the myth of market perfection, George Cooper shines a spotlight on two long-ignored prophets of economic reality, John Maynard Keynes and Hyman Minsky. Keynes, once hailed, then sidelined, saw what others couldn't: their economies aren't clocks, they're crowds. Driven not by perfect logic, but by fear, hope, and herds. And Minsky, he gave that chaos a name: the financial instability hypothesis. His warning was clear. When things seem most stable, when risk feels distant, that's exactly when the seeds of the next crisis are sown. Cooper doesn't stop at diagnosis. He offers a prescription, a radical rethinking of what central banks should be, not passive firemen reacting to flames, but proactive architects shaping the system to prevent the inferno. Instead of targeting inflation alone, Cooper says, they must manage credit, the real fuel of every boom and bust. And yes, they must be willing to pop bubbles on purpose before they burst on their own. That kind of leadership isn't easy. It won't win popularity. But it might just prevent the next collapse. So what's the real takeaway? The system isn't broken. It's doing exactly what it was built to do: inflate, collapse, repeat. And every time, we act surprised. Every time we tell ourselves, no one could have seen it coming. But someone did. This book is more than analysis. It's a spotlight in the fog, a challenge to rethink the very DNA of our economic beliefs, to stop treating crashes as accidents and start understanding them as consequences. The fairy tale of efficient markets is over. It's time to grow up and face the messy, unpredictable, human reality beneath the numbers. Next time the music's playing and everyone's dancing, remember the silence that always follows. The Origin of Financial Crises. Read it. Rethink everything. Like, subscribe, stay prepared, because the next crash, it's already on its way.